Hi, everybody. I am Rakesh Murria. I'm the COO here at Ascension. Today, we've got a reasonable amount to cover, which is about the Ascension SEIS and EIS fund, the benefits of SEIS and EIS we're going to cover too. Ascension is an early stage technology investor. We've been investing on tax efficient terms since 2015. We have a tax efficient review score of 86, just about to have our sort of new and updated review now. We were really pleased in 2022 to be awarded the Seed VC of the Year at the UK BAA Investment Awards, so the Angel Investment Awards at Seed VC of the Year. And we're also known as being one of the most active investors in the early stage technology space. This is for intermediaries only, so I won't go through too much of this. To start with, I'll give you a preamble about Ascension before diving into the meat of the subject. Ascension's ambition is to be the fund of choice for founders and investors. We do that with our team of investment professionals and operations people, as well as our venture partners, of which we have 17, who own 1/4 of Ascension between them. So they're 25% equity holders in the business. And they've got multiple $100 million and $1 billion exits in their own name, not in our track record, as well as a rolling platform of mentors where we try to connect our investments with industry insiders, industry experts to help those businesses grow. And then we back that up with the kind of infrastructure that you'd expect from a large fund. So we have moved to a new state-of-the-art online portal, which has full online application facilities, hosting of your contract notes, hosting of EIS certificates, EIS 5s, EIS 3s, etc., as well as your investor updates, all sitting in one place. You can manage clients across multiple funds there as well. And then for those that have clients that qualify as non-dom, we also have an offshore bank account facility as well. As I said, we've been doing this since 2015. We've got an AUM of 100 million. I joined 5 years ago in 2019. When I joined, the AUM was 16 million. And so you can see the business has been on quite a strong trajectory of growth since then. We've got 150 businesses in the portfolio. And we've had 14 exits now, 14 profitable exits since between 2019 and now. And we actually had 8 in 2022. We've had a couple more this year as well. So why do we consider Ascension to be the fund of choice? First of all, we've got a diverse and experienced team. We've got the right kind of investment infrastructure for you as well to work with to make us good for working with investors. And then we've got this network of venture partners that between the venture partners and the management team, we've actually invested over £4 million of our own money into Ascension's funds. I said we wanted to be the fund of choice for founders and investors. We strive to have a great relationship with our founders. We have had over £1 million now reinvested into Ascension's funds by its founders that have exited their businesses and put some of their proceeds back into Ascension's funds, or they're running later stage businesses at this point, Series B, Series C businesses. They're earning significant amounts of money and they're doing their tax efficient investing through Ascension. And we're also experienced at this. So plus investments, we actually have about 186 at the moment that we have live. We think prime access to the UK seed deals and was recognized for expertise. That means that we are trusted by institutions as well as individuals. So Ascension has a tax efficient business that it's been running, and then it also has an institutional side of its business. And so that's split 50-50 roughly in terms of our AUM. The institutions that have backed our institutional fund include Nationwide Building Society, Aviva, Comic Relief, Better Society Capital. It's the government arm that uses the sort of money in dormant bank accounts to allow it to be invested. These kinds of companies and institutions, as well as high net worth family offices and foundations, have backed us direct. I've just added in a little quote here, Tax Efficient Review, issue 470. Achieving profitable exits is one of the hardest things to achieve. The holy grail, as they described it. So this is the team. That photo looks like it was taken on a beautiful summer's day or whatever. That was taken on January the 15th. It was absolutely freezing when you're doing your new brands. You can see the only person that was there that was warm. It wasn't a person, it was Joel's dog, our founder's dog there in the middle. And to that, we've added Bill Bosefield, who many of you know, and also recently Ben, who some of you have spoken to too. In terms of, just going to quickly zoom in a bit here on the board and venture partners, pulling out a few of the venture partners specifically to talk about. On the bottom right, we have Tony. He was the co-founder and chief scientific officer of Moderna, extremely well known in the biotech space. You'll see that Ascension has some investments in this space as well. One of the things you'll find is that great founders look to find great angels to work with. When you're founding a business, you're looking for an angel with relevant experience to help you grow your business. Lots of people will approach someone like Tony or Vin, who I'm about to mention, asking for advice, asking for how they should run their company. But that gives us a unique access to some companies that you may not see in a normal EIS fund. Vin, on the middle row, has founded multiple businesses. She was Elder Street Investment. She's founded and exited multiple businesses, one of the most significant being Advanced Computer Software, which she sold for 1.2 billion to Vista Equity Partners. She was called the Queen of SaaS by the Sunday Times. I think they meant software as a service. And then on the top left here, you've got Faris, who's actually a company rather than a person, but it's a boutique M&A business. They actually helped sell Jean's company before he founded Ascension, Jean being an exited entrepreneur himself. And that business really helps our businesses get into the right structure and sort of position for a good exit. So if you can imagine, we're helping those businesses grow and eventually we want to exit them, and having someone like Faris as one of our venture partners actually helps structure these businesses as well. And we ran an event earlier this year where we had a bunch of our later stage businesses doing a specific workshop around making sure they've got the right metrics for exit. And so all of these things we think gives us what we consider to be a unique recipe for deal flow, access to seed deals across the UK. We've got this brand recognition that I talked about. We've been doing it for a long time. We've got some campaigns that run alongside our institutional funds. We've got our venture partners who we consider to be beacons in the market, bringing in unique deal flow. We've got the wider community that we've built. And then we've also got the really useful part of our network, which is our founders. And our founders bring us deal flow because it's a startup ecosystem. So they get to see lots of people who are working in the same space, the co-working spaces they work in, et cetera. And they bring us interesting deals. And we've certainly invested in a number of deals that our founders have recommended to us. But where they're extremely useful, particularly at a time like now, when there are a number of oversubscribed rounds into these new technology businesses based on AI, for example, is referencing with founders is really valuable. If an oversubscribed round is happening and you want to take part, being able to talk to our founders, see what they think, find out from them what it was like to work with us is just a really good way of differentiating. And because of all these sort of ingredients, we see about 3,000 deals per year. You can rule about half of them out straight away, as you could imagine. That leads to about 1,500 first conversations and gives us about 25 investments across all our funds that we'll make from that kind of top funnel of 3,000 deals that we see. So now I'm going to jump into the benefits of EIS and SEIS and give you some worked examples. I'm going to start here with EIS, which, I think you'll all be familiar with in terms of the availability. So I'm just going to talk about this a bit because I'm then going to jump into the SEIS, which you may be slightly less familiar with and obviously builds on the benefits of EIS. EIS offers attractive income tax relief, 30% on the investment. Investors can invest up to £2 million per year on EIS terms if they do based on 1 million of standard EIS and 1 million of knowledge intensive EIS. I'm not speaking about carrying back. You can defer capital gains bills, which is extremely useful and EIS is used for this a lot. And there are a lot of estate planning benefits that come with it as well. So for example, if you defer your capital gains bill using EIS and you pass away, the capital gain dies to you as well, right? As well as being income IHT free for the first £1 million of investments. And you've seen some of the changes that the government made in legislation. The eagle-eyed amongst you will notice that it says 28% here on the CGT number. And you'll think, hold on, I thought the second property went down from 28 to 24 and the max went up to 24, so it's harmonized. Actually, those people that earn carried interest, fund managers, hedge fund managers, etc., they still pay 28% in CGT on the earnings they make. That's rising to 32% in April. And those people, there's a few thousand of them, but they pay 5 billion in tax. So if you have any clients in that space, again, this can be quite a useful thing to think of. And then you also get loss relief on failed investments. So investments that if they fail, you get up to 31.5% loss relief on the investments as well. And then finally, this is investing for growth. So there is a capital gains tax exemption on the exit. So on the proceeds you make if you held for 3 years, then you'll pay no tax on them as well. So I'm going to jump just to kind of overlay SEIS on top of this. So with SEIS, it's a significantly smaller amount that you can invest. It's an earlier stage investment, more risky than EIS, you would say, in terms of it, but it has a tax benefits profile to go with that. It's also probably got higher risk, but also a chance for higher rewards because this is probably the lowest valuation that these companies will be invested at. But the net story is that in reality, a well-planned SEIS investment can put only 13.5% of the investment at risk. And how does that happen? First of all, you've got 50% income tax relief. You can invest up to £200,000 per year, but if you imagine a £100,000 investor can get 50k back in income tax relief. Instead of there being any deferral in capital gains, there is a write-off of up to 50% of the SEIS investment. And again, here you can see I've picked 14%, which is half of the 28 that you would get if you were one of those highest CGT payers. My worked example I'll go through in a second, use the equivalent of a second property being sold. But you can see here that's rather than being deferred, it's a write-off. So there's a significant amount of benefit that you can get there, and it's for the tax year you're in or the tax year before. And then you have the same loss relief benefits and capital gains tax exemption. So if you can imagine 50 plus 14 plus 22.5, etc., that's how you get to this kind of what is my worst case scenario with a well-planned investment, 13.5% at risk. Now, just going to jump into an example. This isn't the way that we like to describe it, but sometimes looking at it from the perspective of what's at risk rather than what's the upside, just gives you a kind of picture of the kinds of tax relief and the things that are available. So using that as a worked example here, using these numbers and our actual fund thesis and our fees, 1.4x return on one investment out of a portfolio of 10, and basically pay you back in full for your investment, including all of our fees, because those tax breaks are so attractive. So I'll walk you through this example here. This is a £100,000 investor that has paid their investment fee separately, which we make available as an offer. So first of all, it's easy for you to calculate the exact amount of tax relief, but also for me, it just does 100,000 divided by 10 investments, makes it very easy for me to do the maths. And then I've also done a CGT write-off on the profits from the second property sale here on this 100,000, so £12,000 of CGT relief. So at the start, you can see our investment fee. The next thing you can see is the upside of the CGT write-off. And then we have these 10 investments that we made. And investment one, 10K is invested, it has a 4 times return. And so 10,000 comes in, you get the 5,000 tax relief, £40,000 is returned. I've included our Ascension fees, performance fees here for a profitable return on that SEIS investment to give you the net return there. And then the other 9 businesses have failed. So 90,000 was invested, there was 45,000 of tax relief, and then another 20K of loss relief that came for those. And then, of course, I've planned this whole thing to be over 5 years in this example, so that we're not pretending that we don't have management fees. So then take out our management fees, and you can see that £100,000 investment has yielded £104,000. What you have to believe is we've gone from a worst case scenario to a next but worst case scenario is, can I get 1.4x return out of those investments? And then you'll say and by the way, if we took say CGT out, by the way, it goes from 4x to 5x. If you say I don't have an investor that has any form of CGT liability, then we're talking about 5x instead. And then just to give you context for that, Ascension has 12 businesses across its 2015 to 2019 SEIS funds, the more mature funds where they've had 1 or 2 raises, that are valued at a 5x multiple or better today. Right. So although past performance isn't a reliable indicator, is for what I need to believe, can I believe this scenario in terms of downside planning? And then we'll talk in a moment about the track record as well. And on EIS, with the terms that we offer, a 1.5 point times return can deliver the same profitable return for your investors again. I've gone into the worked example before. These slides will be available after. I won't dwell on this too much. But again, using exactly the same methodology, all our fees, everything in, so you can see that what would it look like in a real world scenario. So I'll give you a quick selection of our businesses here. You can see we've got some exits on the right, starting from our more recent investments to our more mature investments. I'll touch on Tembo, has won the UK's best mortgage broker for the last 2 years. We originally invested from our SEIS fund. We've most recently invested from our knowledge intensive fund. So it's moved back to the start of this queue, but it's in a 2020 investment and then a 2024 investment. That business is doing extremely well, has just raised £12 million from a US VC at a 63 million valuation. We've got Farmland, again, an SEIS and an EIS business working to help agricultural businesses plan and manage their crop yields better, for example. And then we've got a company like Urban Legend, it's an RKI fund. If you know Matt from Round Capital, most people do, one of his favorite businesses. It's a company that is revolutionizing the baked goods industry through producing low-calorie donuts that have less calories than a slice of toast with butter. They taste great, they work great. They're actually rolling out in Tesco's across the country. And the founder was actually on the board of an offshoot of one of our institutional funds, and we've worked with him since. He was a growth manager at Innocent, was CEO of Grays, and now has Urban Legend. So just to give you like a sample of some of these businesses, one of my other favorites before I move on, Mealgy, a business that takes the waste products of the whiskey industry and turns it into fish food for the salmon farming industry in Scotland. Fun fact, there isn't enough fish food in Europe to feed all of Scotland's farmed salmon. So they ship anchovies in from the Pacific, and a business like Mealgy, actually great circular economy business, helps replace what's happening, stops happening. and was actually a finalist for the Earthshot Prize. So I've given you a sample. I've talked about us. I've talked about the benefits of SEIS and EIS, given you a taste of some of those companies. Now, can we back it up with our track record? So what this slide shows is based on October 31st, so it's a recent track record, is the straight line down the middle is 1x of the investment multiple. So the amount invested, what is a 1x value of that? And then the green bar is the gross realized value from those funds. And what you can see is across the board, Ascension has started returning money, and in many cases, significant amounts of money back to investors from proceeds from the exits that they've had. And then the blue line on top of that is the unrealized value still on the table in terms of, set to be realized. So the value of the fund overall. So for example, you can see that when you add in tax relief, our SEIS 18, our SEIS 15, our EIS 17 is already over £1 returned per pound invested. And we have a number of other funds on the way. You can see here our SEIS 17 fund. It's actually one of our poorer performing funds. You can see we went slightly too early in the 2017 AI movement. 2017 was the year that Google published the Attention is All You Need paper that effectively described what's called the transformer, which is the kind of architecture that's being used by all of these AI businesses now. Actually, that fund was performing quite well. There's been a couple of failures in it, but even now, we're still quite confident that investors will still return all of their money when they're taking into account the tax reliefs, etc., that they'll get. And then finally, right down at the bottom, institutional fund focused on reducing the additional cost of being poor. It's called the Proprietary Premium. Even that has started to return significant amounts of money back to investors. You can see the first 2 years of investments are nearly fully returned back to its institutional investors. So zooming in on those exits, these are the multiples of the first investment that we've had, but you can see here we've got exits for ranging from 10 and 9x's. We've got a couple of 10x's, 9x's, a few 6's and some 5's as well, dropping down to 2s and 3's, and then some at cost. So a broad spectrum of exits. The most recent exit we had was a business called Bulbshare, which exited for 3x. I think one of our most interesting exits, and I say interesting in inverted commas, was a business that we invested in November, Proprietary. And that business actually exited 3 months later. So I think Eli Lilly were originally going to be an investor. We helped Proprietary in their sort of first EIS round, but they got a cash offer from Eli Lilly 3 months later. And actually, with investors' consent, we were able to reinvest the proceeds straight into EIS in the same tax year. So effectively, investors got like a little boost in that year. If you've got any questions on this, feel free to drop either myself or Bill a line. Finally, the VC badge of honor, having sold a business to Apple, Credit Kudos exit to Apple for 150 million. And from our institutional fund, trying to show you that there's a good mix of exits across the board. So just going to move on to what we're looking for when we're investing in these businesses. So we have different investment sectors that we invest in, and they are fintech, next gen media and new work, commerce, health, deep tech, and sustainability. Ascension is a tech generalist fund, and our EIS funds, our knowledge intensive fund in the EIS space, and our SEIS funds invest on the same thesis, just at a different stage, so the SEIS being the earlier stage, the EIS and KI being later stage investments into that space. Those categories are quite broad, and I would consider us to be a technology generalist investor in terms of how we do it. And then the real important things that for us around the criteria of what we're looking for. At the early stage, it's really about the team. You need to believe in the team. They've got to have relevant experience. We're looking for front of house and back of house, someone who can build it and someone who can sell it. We're looking for a scalable product that doesn't require tons of implementation. For example, if you're in a SaaS business, it allows you to scale with your growth easily. A significant market size, multiple players need to be able to win in that market. In the EIS fund, we're looking for product market fit, which is really making sure that the business, it's a great founder's probably sold to their previous business that they work with, for their first product, but who's, buying number 2, number 3, number 4? Do you understand how you're going to get to market? They're typically doing about 20 to 40K in revenue in the EIS fund at the point that we invest. And then what we consider to be the secret sauce of all this is distribution. So if you understand your distribution, then you've got a differentiated way of getting to market. If you've got consumer-facing businesses, understanding your distribution is the most important, because there's this horrendous stat that basically about 80% of money that goes into consumer-facing businesses from venture capital basically goes back to Google and Facebook in terms of ad spend. And then finally, after all that, it's about the co-investors. We talked about how our venture partners are beacons in the market as angels. Who are the co-investors in that business? Are there any relevant angels that will bring great experience? So that is us. I'll very quickly just talk about the funds and their structure. Ascension's EIS fund and our SEIS fund have the same upfront infrastructure, so 5% investment fee with 95% of the funds invested. You'll see other funds that have lower upfront fees, for example, but they do things like hold back on their management fees, so actually maybe 89 to 90% gets invested. With Ascension, 95% gets invested. We have a 1% AMC, which is only on realizations, and that is 1% for the first 5 years, and that drops to 1% of live investments for the subsequent years. To a minimum of 0.5, and it's capped at 10 years in total. And we have a great performance fee hurdle as well in the EIS fund, a fund level 130%. The SEIS fund, as I said, has exactly the same upfront fee structure for everything else as well, but a slightly different performance fee structure, which we can go through with you, which is an investment level 25 fund. Is capped at £2 million. So for SEIS, so we won't accept more than 2 million, which will invest in about 10 deals. Basically, above that, you can invest in EIS terms. We're making a significant amount of that available to advisors who would like to work with their clients. And then, of course, the EIS fund has a score of 86 from tax efficient review. And then finally, just to give you that picture that we talked about, we've got the SEIS and the EIS and KI in the same sectors, from pre-Series A to late seed in terms of our investments. And then we also have, for those seeking rapid deployment now, something called the Ascension Carryback EIS. That's designed for you if you're seeking in rapid deployment right now. It co-invests alongside Ascension's funds, as well as being able to take follow-on opportunities that our funds may not be able to. And that will give you, if you're an investor in our EIS fund looking for tax returns this year, you'll get about 6 deals in the EIS if you were to invest from January, and you would get about 10 deals in the carryback to give you that idea of balancing of the portfolio. And then we also have our Fair by Design EIS, which co-invests alongside our institutional fund, but gives you the tax benefits. So whistle-stop tour of Ascension. Thank you ever so much for coming along and spending the time to listen. If you have any questions, contact myself or Bill. Our details are here. And we look forward to following up with you and speaking to you soon. So thanks everyone for coming. Have a good day. Cheers.